Okay, well, thank you all for coming here for our conversation on basically the investability of clean energy going forward. I think we have a terrific group here. Let me introduce first to my immediate left, Martina Chung. She is the president of S&P Global Ratings. Then we have Salim Samaha, who is a partner at Global Infrastructure Partners, and then Steve Comello, who has joined the EFI Foundation from Stanford Business School. So I think they all come with different perspectives to the problem at hand, and I think that hopefully will lead to some interest and some insights as we go forward. Just to frame things a little bit, obviously, well, here in the United States, we've had a spate of legislation in less than a year, the infrastructure law, the CHIPS and Science Act, and the IRA, Inflation Reduction Act, which really, I think, set a new foundation, certainly for expectations in terms of clean energy projects, for the clean energy transition, and expectations of substantial support for moving forward with projects. Many of us would argue, however, that there remain a lot more to do to make enough clean energy projects investable, to have the investment committees say yes to going forward. Probably today we may hear from our panelists, but we would certainly argue today that there's more capital available than there are, frankly, investable projects, despite all of the carrots being offered by the IRA, for example. But of course, in the longer term, we will need to move beyond carrots. There won't be enough carrots to support the scale of the transition that we are talking about. And so throughout this period, we're going to have to find the ways to really increase the investability of projects, to increase the flow of private capital, certainly in partnership, often with government support. So that's really the issue that we are about to discuss. And what I'm going to do is call on our panelists to make some initial remarks, their view of what the issue is and how to approach it. I'm going to start with Steve Comello, then go to Salim, and then go to our third panelist,
Martina.
Terrific.
Yeah, thank you so much, Ernie, and great to be here. So I spent a lot of time thinking about legislative, regulatory, and administrative policy changes that really need to be in place to help drive private capital to decarbonization investments. And by decarbonization, I mean investments needed to reduce the emissions essentially to zero as quickly as possible. And it's important to get private capital involved because I just want to level set what the issue is here. That essentially we need incrementally about $5 trillion a year, right, globally to get to net zero by 2050. And by some estimates, we're at about 30% of that. So the $3.5 trillion per year, that's not a small amount of money. That's essentially the same order of magnitude of all the net new capital flow into institutional managed funds every year. And so essentially that type of fund, that scale of funds, that needs to flow much more into decarbonization. And so, and again, the net new flows, that's for all sectors of the economy. And so essentially you need to create an opportunity or sets of opportunities within decarbonization assets that you would move those funds from other sectors of the economy into the clean energy transition. And that is what's needed here to enable bankability, right? Essentially to create this, to create a competition or to create the necessary need for funds to go, you need to get the investors interested, and that is the function of policy. in the absence of a carbon price, in the absence of a regulated limit on carbon, then essentially what you need is sets of sticks and sets of carrots. We have some carrots that have come out of IRA, but really what we need, IRA is at a high level, and what we spend a lot of time thinking about is much more on the deals level, that what does it take to get an investor who is interested in a decarbonization asset to yes. And there we basically take the perspective of what is needed what is needed then for an investment committee to say yes, and I'll continue my comments in a moment.
Salim.
Thank you, Stephen. Look, I'm an investor, and I recognize that nobody really has an answer about exactly how we're going to get to net zero, but I find that good systems ultimately get us there, and there's a wisdom to having good processes and good systems. I think the fundamental thing that is missing is a price of carbon, and it's going to certainly take some political will to do that. And the second thing is really permitting reform, because no matter what the price of carbon is, if you can't build new infrastructure, new assets, then you're not going to be able to move the economy towards net zero. And the cost of that transition is going to be far greater. So if we were able to build a lot of transmission all over the US, we would certainly reduce the overall cost of decarbonization by being able to interconnect all the different resources and the different regions together. That's obviously going to have to be a global solution. You know, you can't have Europe be the only continent with a border tax on carbon. There needs to be greater scale in order for that mechanism to operate efficiently. There will certainly be haves and have-nots, winners and losers in that transition that also needs to be addressed, and that's actually the role of government, to be very thoughtful around how you redistribute the funds that come from a carbon price. And I think that's quite simple, because I think that type of system will create innovation, because it'll give investors a confidence to invest. It'll give investors the confidence to innovate, and the visibility about the commitment of all the different constituencies to keep pushing in the right direction. The other thing is there isn't enough of a focus in my mind on the carbon budget. A lot of people think you flip a switch and all you need to focus on is you're going to get to net zero by 2050. There are a lot of things that could be done today that people are not doing, because the idea is this isn't green enough. But in many cases, these things will actually help you reduce the erosion of the carbon budget. And I think we need to be more pragmatic, and people need to come together and educate everybody on how energy really works, what's possible, what's not possible, and how we can push forward in the right direction together.
May I ask, Salim, just could you clarify your definition of carbon budget? You mean the amount of carbon left to emit to reach certain concentration goals? Is that what you mean?
Yeah, the level of carbon that where if we exceed that level of carbon emissions, we will not achieve our net zero target, or right. 1.5 degree global temperature rise by 2050.
Yeah, okay. And I would just add that I would say carbon budget is a concept that's very closely tied to the idea that CO2 in the atmosphere is cumulative. So it sits there for a long time, I think, therefore setting a budget. Martina.
Yeah. Well, thanks for having me on this panel. It's very interesting. I think for us, we started with the problem statement, and that is that for some sort of alignment by 2050, our commodity insights teams are looking at the need to increase the percent of renewables in overall energy consumption by 10x, from 3% today to 30%. And that actually assumes that 10% of carbon is captured by either direct air capture or CCS, and I think we've all been looking for ways in which to scale that technology more effectively, because we don't see very clearly where that's going to come from as of yet. The gap, as Stephen mentioned, depending on which report you look at, anywhere from $1.5 trillion annually to $3.5 trillion annually, and lots of different assumptions go into those reports by the different NGOs and various other organizations. But I think we can all agree the gap is big. So what do we do? From our standpoint, it's going to require a multi-layered and very collaborative approach. So certainly the IRA, incredibly helpful and supportive in interesting ways. The tax credits, tax transfers, are very, very helpful in getting a lot of this kick-started. But there's also, quite a few other programs, the European Global Gateway Plan, the infrastructure plan announced by the Chinese government last year. These are all things that will be very helpful. In order for this to take shape more productively, I think we're going to need to see crowding in of private investment into some of these areas, in particular into projects, for example. And I think we might get to it later, but in particular into projects in developing markets. There are a lot of ways that can be done. We see the MDBs, actually helping in very good ways, but there are also ways in which it can be done, working specifically with, with some of the financial institutions, where we would have guarantees or risk-sharing facilities, and there are other really creative ways to look at this as well. So I think it's going to take all aspects of the financial ecosystem to make sure that the capital is there, that it's being put to use, and also more importantly, or as importantly, that it's being put to use in the right areas. So let's not forget CCS, direct air capture, and let's also not forget the fact that fossil fuels, hydrocarbons are here for a reasonably long period of time. There's a lot of views on when peak is, possibly the middle of the next decade. In order for us to continue to meet the needs of global demand, we need to take a look at that and how we actually can make that less carbon intense over a period of time as well. So the financing needs to go to all parts of this in order to be able to advance the story.
Martina, could you just repeat what you said in terms of the percentage to be solved by direct air capture?
So our Commodity Insights team is suggesting that it should be about 10%.
10%,
Yeah.
Okay, yeah. Because we've heard IEA, for example, with larger numbers that strain credulity in terms of the size of the industry being suggested.
Yeah.
So that's useful. Steve, I want to go back to what you discussed. You didn't mention anything about what might be part of that required investment stream coming from leaving some of the current investments in fossil energy, for example. What's your take on that?
Right. So some estimates from IEA, basically, if you zeroed out all investments for capital to fossil fuels, you're going to get about 800 billion a year back, right? And if I do quick math, 800 billion is much less than the 3.5 trillion. And so essentially, and also to Martina's point, you're not going to zero that out. In fact, most likely in the short term, you would have to increase it simply because there hasn't been a lot of flow in CapEx with respect to E&P in fossil fuels over the past 10 years. And there's a tremendous increase in demand for fossil fuel, at least in the short term. How it turns out in the long term is a different story. So you can't look only to the fossil fuel industry to essentially move 100% from what they're doing into decarbonization assets. And so essentially those investors who don't even think about energy, who don't even think about climate, they're the ones that have to be incented to direct funds into this industry writ large, and they need a compelling reason to do so. And that's what series of carrots and sticks will allow.
In fact, to follow that up, and Martina, you mentioned the ongoing need for fossil fuels. So for both of you, how do you see maintaining the needed level of investment in fossil fuels to manage a real transition from where we are today to low carbon in, say, 3 decades?
Yeah, I think a lot of people looked at coal in the U.S. in my mind, and they said, we're getting rid of coal very efficiently, therefore we've done that, now we can get rid of oil and gas globally, as if it's something that's very simple. And I think the reality is far different. It's going to take a long time. So there will be very big price signals like the ones we've been experiencing over the past couple of years that will incentivize companies to invest in it. It might be very painful for the consumer. It will require changing some of the policy. And ultimately, if as an investor you're investing in a resource and instead of previously you'd expect to get your money back over 30 years, and now you expect to get it back over 10 years because of all the uncertainty around policy, the price is gonna go up. And I don't think there's any way to avoid it if you fundamentally believe, like I do, that oil and gas are going to be still required as part of the transition for a long time. Mm-hmm. I think there's a big danger for the whole industry to be vilified in that context. It already is being vilified for not investing when ultimately they're getting clear signals from the capital markets, their investors, that you need to be very thoughtful about what is the right cost of capital to charge for these investments. And that higher cost of capital is going to create higher prices for everybody.
Mm-hmm. Martina?
Yeah, I mean, great points. I would just add that investors are always looking for, attractive risk and return, and right now, a lot of these companies are experiencing such high demand that there is, in fact, very attractive risk-return profiles for these companies. Whereas, 3, 4, or 5 years ago, when the energy transition dialogue was upticking, it might not have looked nearly as favorable, for example. So I do think that there is a better understanding. There was, for want of a better phrase, essentially a reset on the energy transition dialogue last year with the geopolitical challenges and energy security challenges that we've all been talking about. And I think that's improved the appreciation for where we actually are and what it's going to take.
Mm-hmm. Especially for the two of you, are you of the mind that it's only non-concessionary returns that is going to in fact liberate large amounts of private capital? And if that's the case, how do you gain the confidence that you talked about, Salim, the confidence in policy having sufficiently long support to garner those returns?
I think that's that's a $1 million question, right? I think ultimately, once you get a price of, I come back to the price of carbon, once that's out there, I think that will lead to a visible path for investors to generate their returns and to have the confidence that they can generate their returns and that they know what the rules of the game are. And to the extent that you don't have that, then I think the whole energy transition is going to be more expensive. So take the IRA, for example. It's wonderful subsidies at one level, but what happens at the end of that $3 a kilogram PTC subsidy for green hydrogen? Do you assume that there's another subsidy? I think that's a bad bet. Do you assume that there will be a price of carbon? A lot of uncertainty around that. So it puts pressure on you as an investor to figure out how you can get your returns, as much of your returns as possible over a 10-year time frame.
Well, yesterday, John Podesta emphasized the 10-year time frame with IRA. Are you buying it?
Well, I think it will be enshrined in the regulations, and what's great about it is you know what it is, and you know how long it will last. So it's far better than a carbon price that can move around every single year in some respects. It's far better than policies that politicians can put their thumb on the scale and change the rules every year. What's the voluntary obligation? How much? What do you include? What do you exclude? Those rules are always shifting, which creates an enormous amount of uncertainty for an investor. What I worry about from an IRA perspective, and nothing is perfect, is it creates some odd incentives. Clearly you need subsidies, you need somebody to pay for the cost of carbon abatement, but it doesn't always incentivize the most efficient solution. And then second, I think the impact of the IRA is going to be far less if you don't have permitting reform, because you're not going to be able to build the right assets in the right locations. I can tell you, for example, the best renewable resources for hydrogen are not next to the coast where people want to export it. So how do you actually produce that hydrogen? How do you move it to market? What is the cost of that? There's a lot of uncertainty around it.
Do you want to weigh in on the color of hydrogen?
I would just say I would focus on emissions. What are we trying to achieve? We're trying to achieve emissions reductions, and we have to focus on emissions. We've spent the last 15 years building top 10 global renewable business at GIP. We've got 16 gigawatts in operation. We have 175 gigawatts in development. And then we have a pipeline system in Louisiana through Enlink, one of our portfolio companies. And in one deal with Exxon and CF Industries, there's going to be 3.5 million tons of carbon abatement. That's the equivalent of 4 gigawatts per year. Mm-hmm. And those numbers are staggering, but you still see a lot of constituencies push against carbon capture, even though it can be a very big part of the solution.
Mm-hmm. Martina, this discussion and discussion around hydrogen reminds one that in the United States, even the infrastructure law and the IRA themselves are inconsistent in how clean hydrogen is defined. And I don't believe either definition agrees with any other country's definition. How do you see, especially from your S&P Global perspective, how do you see any kind of market formation when we have this kind of lack of even the most elementary standards?
Well, I think we've seen how companies and the private sector just generally can actually, with a lot of will and a lot of commitment, drive a tremendous amount of activity, and I think a lot of that has actually happened in the last 2 decades, long before IRA was conceived and other programs. So I don't necessarily see some of the challenge with standards as being a problem. I think it's more to attract investment. It is about the risk that you're taking on, and there I think there's a risk of lack of maturity of some of the technologies, some of the products, getting there rapidly, but having an understanding of how much risk you're taking on based on how early some of these things are is it's just a fundamental challenge for any investor. And then I think the other thing that I would just add to the point that Salim made around pipelines and how to actually move something from to the coast or from inland, et cetera. I think the other sort of major challenge is in sorting through global supply chains, right? So if you're going to de-risk some of these investments, it's not just the maturity of the technology, but it's also knowing you can get the energy to where it needs to go, and ultimately that the supply chain required to produce it is credible and that you have a line of sight on that. So those are, I think, some of the more kind of like basic challenges that I would see. There's a ton of innovation. You mentioned there's a ton of dry powder. Our estimates were that globally at the end of last year there was about $250 billion in dry powder in private funds that could be deployed towards this. Obviously, GIP is a huge part of that, but there's a lot of other companies that have name brand funds like TPG Rise and BNZ from General Atlantic, and so there's plenty of capital out there. I think it's just more transparency, better understanding. Salim and I were just talking earlier about this concept of a carbon budget. We've launched something that's a reasonably simple framework based on the IPCC framework, which is a carbon budget index. And I can tell you that some of the more sophisticated asset owners that we've engaged with on this really have a good understanding for how that works and appreciate the simplicity of it, because it actually allows you to make very concrete decisions based on real world impact, right? So lots that needs to happen, but I'm not sure that I would say I think your original question was, do we need to get standards in place, et cetera? I mean, we've been operating with, I don't know how many hundreds of ESG standards for the last however many years, and we've still managed to make tremendous progress.
I would argue an ESG standard is a little bit different from a definition, of a quantitative definition, but interesting. On the carbon budget, I would just make one comment that I think too often in the discussions, we talk about the end state, like net zero at some year, but we fail to talk about the fact that since it is a cumulative issue, how you get there matters. And right now, as we are probably being a bit profligate in spending that budget, we pay that price down the road in terms of the cumulative impact. Steve, I want to come back to some of the work that you've done. We've heard now a couple of times, more than a couple of times maybe, carbon capture and sequestration put forward as a significant potential pathway for carbon reduction. Not said, but the power sector, but maybe even more so the industrial sector, for example. If we think in terms of the barriers to investability, a CCS project looks awfully complicated. Mm-hmm. There's an industrial plant for capture, there's a transportation issue for CO2, there's a sequestration issue, there's a monitoring issue for some undetermined period of time. How do you see clearing that underbrush to make CCS a more investable proposition for our colleagues here?
Yeah, it's hard but necessary, and I think it came up earlier that if you don't have CCS, especially something like in the power sector, then essentially you're going to be paying a lot more for energy overall, right? Because it provides clean baseload power. And then also from the industrial sector, some alternative methods to producing steel, cement, and so forth. Those are technologies in the future. It doesn't necessarily abate some of the existing facilities now. So we had IRA that came out, $85 a ton, fantastic. The tough thing about that is, by our calculations, about half of that incremental value has been consumed by inflation and interest. And so there's still quite a few, on average, applications that are out of the money. And so if I had my druthers, the 45Q is quite helpful, but to really draw down that cost, especially the first of a kind cost, and get to an nth of a kind, you need two forms of lower cost capital. Number one is cheap equity, and that's another way of saying providing a grant. So if you really want to develop certain technologies, and one other point that I want to make on CCS is every application of CCS is slightly different. Again, we need it, but having experience on an NGCC and having experience on hydrogen, having experience on coal, these are separate. They all have their individual learning curves. So essentially, we need to support all of those. And what you would need is essentially grants to take from first of a kind to nth of a kind on each of these applications. And then once you're basically at the 45Q level, then essentially you would have some low-cost debt, and that would be the LPO that would provide that. The issue is that the way it's constructed right now is you won't get to those learning effects on one or two applications. You need probably, our calculations for the NGCC, by the sixth one, then you're basically in the money with 45Q. But you need that trajectory, and that's just on the cost to get you built. you brought up permitting. Completely agree that both at the state and the federal level, we need to think more clearly about that. And then there's the social aspect of that as well. We know that CCS is controversial, and engaging with communities so that investors feel that it's not a reputational risk in backing a technology like CCS is really, really important. And thinking through how you actually do that. What does engagement look like? What is a community? How do you do that effectively? These are some of the elements that need to be considered to remove some of the barriers to CCS.
So just to be explicit, what you're saying is that demonstrating a CCS plant means demonstrating maybe 5 or 10 different processes
Per application.
Yes, each one has such different process conditions that presumably an investor is not going to accept experience in one domain as providing sufficient experience in some other domain.
Correct, and that's how you move from a technology to an industry, right? And that's I think the key part that gets missed in conversations.
So from the investor perspective then, Salim and Martina, how do you see sufficiently effective risk sharing going on to allow one to really get over the hump and move first of a kind and second of a kind, et cetera? I mean, what do you look for as an investor in order to be able to have the confidence that risk will be shared and allocated fairly among many players?
Yeah. So I'll give you a couple of examples. There may be some projects where ultimately most of the return is coming in the form of government credits, and the price of those government credits can change year to year. So that makes it more challenging to deploy significant amounts of capital. We're seeing the emergence of some offtake structures where in the voluntary market, companies that are trying to meet their sustainability goals are willing to sign offtake contracts that provide a floor return. It covers the debt very efficiently, covers some minimal equity return to attract the type of capital that we bring to the table, and then a sharing of the value of those credits. And I think all this is going to work, and you're going to see greater deployment for some period of time, because when you think about the cost relative to the overall pie, it's still very low. So it's very easy to do in the early innings. As the cost starts to stack up, it's going to become much more challenging for those off-takers to do that if there isn't a real carbon pricing that affects everybody to really level the playing field.
Martina, do you want to comment?
Yeah, I'm not an investor, but some of the feedback that we do get is an interest in call it sort of maybe more esoteric type deal structures, to achieve some of that risk sharing capability. Actually, I was on a discussion yesterday evening with an entrepreneur who mentioned that a key infrastructure investor had both taken a stake, but as a developer of real estate, had also essentially taken on themselves to actually build out some of the plants that she needed for her projects, which is very, very creative in terms of moving the needle and demonstrating the commitment and reducing the risk for her and for themselves as well. I think the most forward-looking structures are still in the multilateral area, the NGO area, climate debt swaps, some of these risk-sharing facilities we're still seeing kind of in that area. And so making sure that we continue to have the creativity and the transparency to actually incentivize the creativity in the private space, I think is going to be very important.
Well, I have a lot of questions left, but I realize I'd like to actually turn to the audience to see if there are some questions for our panel from the audience. Please, I see a hand there.
Salim, thank you. So first, thanks to everyone. Very interesting.
Who are you?
My name is Frank O'Sullivan, and I work for a fund, an earlier stage fund called S2G Ventures. My question is for you, Salim. So in the kind of contemporary context, a lot of capital looking at different options, whether traditional energy versus renewables, and in particular, some actors trying to do a little bit of both. And I think there's obviously a lot of tension there vis-a-vis return levels and so on. How is that particular dynamic going to play out? Because they're looking to the markets for their own equity and so on. And I think, it can be quite stark when you're thinking about, let's say the returns that have been seen by traditional fossil assets over the past year versus, let's say, some of the story that's unfolding for some major renewable asset projects in the United States at the moment. And I'm just curious how you guys, GIP, for example, balance that. And in particular, the difference then between you guys as a fund versus corporates in trying to strike that balance.
Yeah, that's a good question. Look, we certainly have investors like everybody else, and there are many things to think about. You have to think about what's the right return, but you also have to think about exit. So, for example, let's assume there's a great oil infrastructure asset. It's really well priced. You're going to get a phenomenal return. But then when you're looking to exit, somebody needs to write you a $4 to $5 billion check on the back end. That's very difficult to do, because what is happening is at the board level of many, as you know from some of the LPs, they're setting these net zero targets, and they're trying to figure out how do they move their portfolio to net zero. And that's a very difficult thing for them to do, because we talked at the outset, you don't have a sufficient number of projects beyond traditional renewables in order to help these institutions move their portfolios to net zero. That said, we still see a lot of momentum for gas. I think there is a growing recognition for its role in the energy transition, particularly post the Russia-Ukraine war. We've continuously invested in that. We did that pre-Ukraine. We have 4 different LNG investments, and we're quite comfortable that if priced right, you can get to the right returns, and there's enough liquidity in the market to exit. Renewables, clearly with returns over some period of time have come down a lot. There's been a topic of discussion. But what a lot of people don't really recognize is even as the returns have come down for mature renewables, and the development returns have come down as well, that margin between development and operating assets has not changed very much. Where people are falling flat on their faces these days is when they go lock up a price, and then they don't lock up their cost structure, and now they're upside down on the, and that's something that's going to be transitory. The last point I'd make, because you had a pretty broad question, is a lot of people think about just electrons. A lot of people think about molecules. I really think you have to, at the end of the day, it's all about energy. And I think you have to understand the full value chain. And we're seeing this convergence of the two in a way that people weren't talking about 2 years ago. So one of the things I encourage our newer investment professionals is to really immerse themselves across the whole chain. And I think this will create the winning strategies long term.
With our time running out, I do want to inject actually one other question. Maybe Martina, you'd like to give a shot at it. How do you see the role of social equity coming into these investment decisions? You mentioned ESG earlier. That may be related to that, but we also heard earlier about how would revenue associated with a carbon price be distributed, which is a social equity issue as well. Any comments?
I think it varies dramatically by region. So on one side, you have double materiality concept in Europe that looks at impact. Ton of investors and financial market participants that we talk to want to know, what do you have on biodiversity? What do you have on nature? You've got the task force on nature-related financial disclosures. And then we know that there's some polarizing views in other regions around the world. So I think it plays on both sides, and it depends very much which region you're talking about.
Okay, well, in the last few seconds, I'll go to our investor for a yes/no answer. Are you more inclined to say yes today than 2 years ago?
Yes.
Excellent. There we go. We have made progress. Thank you all very much, and thank you again for coming. Good answer.
Thank you for attending. Please check the Innovation Agora agenda for upcoming Hub, Pod, and Lyceum sessions. Our next session in this studio will begin shortly.